Hello and welcome back to another video on the channel and in the Discord server. So in today's video, we're going to be discussing the fair value gap, and I'm going to try and simplify it down for you and give you some examples. So the fair value gap is an entry model that we can use day in, day out on the markets, and it occurs on all time frames. So to begin with, what actually is a fair value gap? It occurs when price leaves a specific level where there's less trade volume and activity in one direction, and usually only has one directional movement. So the context of a fair value gap is very important. So the context is stuff like, has price previously taken out a level of liquidity? What time frame is the fair value gap showing on? So I'd personally leave trading the minute time frame for this. I'd personally use this on the plus 3 minutes up to the weekly and monthly time frame. So the higher the time frame, the more valid the FVG actually is. So obviously with fair value gaps, you want to be following structure and order flow. You don't just want to be taking this in the wrong direction of price movement. So let's say we have this example here. Price is in a bearish order flow. We'd only want to take this if we were looking to continue sales. If we were looking for buys, this wouldn't be going in the right direction of order flow and structure. So pair this up with the order flow and structure and you'll be good to go. So the perspective of an FVG is really up to you. Many people believe that sometimes you can have a wick on this, you can, but just know that this is the strongest type of fair value gap when we have 0 wicks on either side of the candle, then a wick to the left and a wick to the right. These can be traded into multiple times and used as an inversion level also. So let's say we have a spike into this zone. So first off, let's mark on our fair value gap, which would be simply between this level, between the wick and the wick here. Why is this the fair value gap? Because between these two wicks, there was a volume imbalance almost within this candle, meaning that this is an institutional candle put into the market. So what do we expect? We expect price to retrace and pull back into this area. And this can be traded multiple times. As long as we get the closure back below, we are fine to have multiple taps and rejections into our fair value gaps. When does this actually become invalid? So a fair value gap becomes invalid once you trade past this. So say in this circumstance, we are in a bearish order flow market. So let's say we have price come back up into our level like so. If price closes like so, this would be an invalid FVG. But let's say price comes in, taps perfectly like so, and reacts something like this. So let's say we wick up, ignore the wicks. We're looking at the body closures. So the body closes back below. We are good for short in this circumstance. It only becomes invalid once you close through 100% of the fair value gap. If we close like this, we're good to go. But personally, I don't like to see my fair value gaps close through our 50% level of the gap involved. Why? Why do I not like this? Well, this kind of shows that fair value gap isn't as strong as we thought it was, and that price will probably break through and come and tap into something, perhaps an order block in this region up here, or a further price point, and we just got the structure, or there was a market structure shift. So I want to go through some examples and show you some of the context that you can use with the fair value gap, because alone it doesn't really work. You need to have the context there to support the entry model that we are using. So if I delete this and go onto the chart, we are going to head onto the 5-minute time frame and just show you this on some 5-minute time frame examples. So I'll come back when I found an example. Okay, perfect. So let's mark out this setup as it's a nice setup that I liked from Thursday, the 23rd of March, London close entry. So the timing around the fair value gap is very important also. So timings, you can learn more about that in our Discord. But for now, we need to understand that in the New York session, the first move of New York is usually market retraction. This is usually the false move and it occurs from 11 till 12:30. and that was a bullish move up until half three in this circumstance. At half three, we had price react from these levels, and we had this as a protected high up here. So if we mark this on as our swing high, our swing low, our new swing high, and then we create a new low. So where would I have actually entered on this? This is the price action I'll be looking at for today. So we have a nice fair value gap within here. Why is this a fair value gap? So we have institutional order flow. So there's only one direction really being done within the market here. We have the time as a confluence also. We then also have all of this developed accumulation, and then we have accumulation on the sell side too. So if we mark this on as this can be liquidity. So this was our sell side liquidity, like so. Just change this so it's a bit cleaner. We've then seen price trade through. Where now can we expect price to go? So after seeing this fair value gap within this candle actually get violated with these closures, we can see this as a market structure shift. Why? Well, we've closed through 100% of the fair value gap. If price was going to remain bullish, price would have reacted from this level and continued higher. So we can understand that price is accumulated with then broken structure, order flow shift, change in delivery. We can then understand what are our next clear targets. Our next clear targets is this sell side down here. So if we mark this on as our sell side targets, so price has engineered these lows in a way that has allowed us to take this setup. So where would we have entered? So personally, what I like to do is I like to mark on my fair value gap. So in this circumstance, it would be between these two levels, as you can see here. So this is our valid fair value gap in this circumstance. We've had the break of structure. We've then had a corrective move into price. We've then reacted once, closed below. We've then came back in and closed, and then finally trade into once more, and then we saw price melt. So if I mark this on as our new fair value gap that we're looking at and get rid of this, price violated it. We can see this as our new FVG. So FVG, and if we do something like this, this is our new fair value gap. And what does price do? Price comes down and fills out our sell side liquidity. After taking buy side, we then have the break of structure, market structure shift. Time is in our favor. We are in the London close period where we always see a big move within the markets. So our entry would simply be on the wick, and then we could cover either potentially this position would still be valid because it could go from the order block. So we'd probably cover this high here, like so, or we could just cover the fair value gap. It's up to you. Personally, I'd just cover the fair value gap. I'd be pretty certain this fair value gap will hold. And then we could see price trade into engineered liquidity down here. So that's our first model and our first type. So that's a sell side model for the fair value gap. We'll now look at a buy side model for the fair value gap. So I hope you understand why we would have taken this trade. We've had the closure through this fair value gap, meaning that the bullish institutional sponsorship is changing to a bearish institutional sponsorship. We've then had a tap into this level, close below, tap in, close below, and then we've finally melted in price into our sell side targets. So that is the first sell side FVG entry model. Let's look for a second one. Okay, perfect. So we actually have a London trade for this buy side inefficiency example. So we have Asian session here. What does Asian session usually do? We create consolidation and accumulation. What do we then see on market open? We then see manipulation. And what has price done? Price has taken out our sell side liquidity. So this is our sell side liquidity. Price reacts. Then what do we see price do? Price comes through, trades through our old fair value gaps within here. So we can notice this as a change in delivery on the 5-minute time frame. We've then created a market structure shift into a bullish order flow. And as you can see, we've created this fair value gap here. So if I mark this on my chart, so we've got this high here. and then we've got this low here, like so. And then we can put on our tool here, make this a different color, and mark this on as our FVG. So this would have been our entry in this model. We've taken sell side. We're now looking to take buy side. So first targets would have been this Asian high. And as you can see, that's what we came and tapped into. And then our next targets would have been this high up here as our more external liquidity. So in this circumstance, where would I put my stops and take profit? I would have simply entered after we've got the push back into the 50% and understood there was a market structure shift. And then my stop would simply go below this low. And then we'd be looking for our high up here. What does price do? Price reacts and we take our high and then pull back into our new fair value gap to continue higher. And this happens over and over. We then have the 11 o'clock market protraction, which is our sell side move to 12:30, which was the false move of this day. We've then had another market structure shift. We've then came back into this fair value gap again, and price distributes very nicely in this circumstance. So that is a quick simplified version of how to understand fair value gaps and understand when they become invalid and valid. So hopefully you can use this in your trading, and I'll see you all in the next video.